The stock market is entirely correlated with the global bank balance sheet. We saw the Fed officially stop QE3 and maintain a balance sheet of approximately $4.5 trillion and then began to slowly allow their securities to mature. Essentially a minimal sell-off of some of their balance sheet. During the period of reduced central bank monetization on a global level, the stock market performed very poorly. 2018 was the prime example. However, now with QE4 in full force and the ECB ready to get back to the printing press, this could severely expand one of the biggest bubbles in history. Hang on tight. You came here for the truth, so let me unveil that for you. Today we're going to look at what's happening in the financial system. All of this data here, if you're just trying to see the headlines, you're looking at the front page news, you are seeing what they say on CNBC and Bloomberg and all of the other mainstream media. You're never going to find out this information. A lot of it is provided by the mainstream, but you got to look into it on a deeper level. You have to read between the lines. You have to connect the dots. Otherwise, you're not going to understand it. The people who are watching this channel on a daily basis are clearly in the know because you are actually actively looking into the data yourself. You are going to see exactly what is going on, at least at a deeper level than the average person. So I commend your efforts. Now, we're going to get into some really good information today. Let's begin. Wall Street has doubts after partial trade deal. Quote, I don't think this gets us to Christmas. What we have seen right now going on with this particular trade deal has been nothing but insanity. It's up, it's down, one day it's on, the next day it's off. In the latest round here, we have seen that there's a trade deal that has gone through. Then, by the afternoon, we had started to realize that that wasn't the case. Nothing was signed, nothing's made official. All we know is what we knew a year ago, and that is China wants to buy a whole bunch of agriculture, particular soybeans. So all those soybean farmers out there are going to be very happy about it. And then we have the fact that these new round of tariffs will not go up in October. But it doesn't do anything with the existing tariffs that are in place. The actual issues that were not agreed upon all throughout the last year and beyond, all of those issues will still need to be discussed. None of that is from this initial phase one of the trade deal. So we need to see some progress on this. The market doesn't really care because ultimately it's just trading on this positive news that we have already been trading on for the entire year, but that's what we're doing here. It's all computer algorithms. Anyway, it's insane up and down. Who knows where it's going to be tomorrow? Now, I want to segue this into this piece of information, and that is JP Morgan warns on the state of the US consumer. The US consumer makes up the primary portion of the US economy, and without that consumer, everything falls very, very fast. But if you're just looking at some of the generic pieces of data that they will show you, you're not going to get the whole picture, okay? First of all, the manufacturing sector has been way down. I mean, it's been not just sluggish, it has actually been contracting. And you can see here that in this case, the ISM manufacturing index, 47.8. So anything under 50 is contracting, and that has been going on from the US to basically all around the world. We've looked at that data, we've looked at the slowing in basically every sector out there, and yet we have seen the stock markets near all-time highs. It depends on where you look, of course, but when you see, for example, the S&P 500, it is definitely hovering around that level. Now, it's been hovering around that level for approximately 21 months at this point, but who's counting anyway? If you take the all-country world index, we are still down from the peak that was back in January 2018. The market's really struggling, even though we've got some stimulus measures that are going from basically every corner of the world in all different methods. We've had much generosity from the central banks. We've had all the different packages like the TARP bailout and so on that have been going on, not just in the US. Of course, it's been going on everywhere. We've had countries buying up basically everything, whether that is different assets that you've seen on all different levels, or it's public works projects that have been going on, increasing the deficits that have been really a massive problem that is not being highlighted by any government because they want to stay in power. Now, if you look at this as something that I show you, it's something that I show you on a regular basis out of coursesite.com. You will see this year so far, US retailers have announced 8,633 store closures, 3,589 store openings. Just to give you an update on that, we have have seen time and time again that this is going to get worse and worse. Now, you could say it's e-commerce, it's Amazon, whatever. I don't really care anymore. I'm tired of trying to explain it. Looking at this tells me that there's a lot of people out of work. That's all. And this just shows you that what we are seeing with the U3 unemployment rate is never, absolutely never going to match up with the actual real information out there. The information that we are seeing is always, absolutely always being clouded, being hidden, being secretly adjusted, and the public doesn't know, and sometimes they turn a blind eye. Just like we saw leading up to the financial crisis, the housing crisis, everybody knew in that industry that there were shady things happening, but they simply turned away from it and pretended that it didn't exist. Well, of course, we had the housing crisis, the subprime crisis, and that extended out all around the world, and the financial system basically went into cardiac arrest. That is troublesome because the same things are going on today. It might be in different markets, it might be way worse, and we will find out at some point. If they are colluding together on certain schemes, we're going to find out about it at some point in the future. However frothy valuations currently seem to be, optimists can always argue they're justified by strong earnings. We've seen this all the time. The news media loves to report it, and the comments you will see constantly suggest the same thing. In the past 4 years, S&P 500 operating earnings per share have grown by nearly 40%. Those numbers, however, may be as airy as the asset prices they support. And I want to stop there to interject the fact that we are seeing this in Bloomberg, and while it's on Bloomberg Opinion, I'm really proud that they're at least saying this in the mainstream media. The average person's not going to ever read this, but it's just good to see it. The US government's national income and product accounts, which cover a broader number of businesses than the S&P, use tax returns and adjust for certain accounting practices, which suggest that corporate profits actually peaked in 2014 and have been stagnant since. Now, what kind of data is the average person or the average investor looking at? Definitely not this. The national accounts also show significant downward revisions to corporate profit margins over the previous 5 years. While one would expect some discrepancies between that data and the S&P numbers, which by the way are based on GAAP, generally accepted accounting principles, the gulf is too wide to be ignored. They get into some of the details here. I have covered this on other videos, but I just wanted to highlight it for a moment because we're always looking at this particular set of data that the government provides, that institutions provide, whether it's the U3 unemployment rate, whether it's in this case earnings per share, whether we're looking at PE ratios, and all of these other things that are just the basic fundamental analysis that companies or agencies or investors are doing. However, when we will look at it on a different level, it starts to look a lot more shady, and you will find this for those who work in the financial industry, at least on a medium level. They know what's going on. If you see what goes on in the financial industry, it is truly worrisome. Now, things can go for a long time. I mean, the scams can be kept going even at such a rate like Bernie Madoff, for instance, which is an extreme example, just showing you that billions upon billions of dollars can be amassed by an absolute fraud. Some last longer than others. That's the only difference. Hong Kong is facing its first recession since the global financial crisis, with little prospect of an immediate recovery as the city confronts its most violent protests in decades. They talk about the different stores and the different businesses that are being affected here. If you're interested, you can read it. Essentially looking at this particular place in the world being directly affected by what's happening in the political spectrum. What's important to note here is that this can happen anywhere in the world. That's why on the back of my latest book, I wrote, "Soon the earth will rumble under the heels of the angry mobs." And this is because people, when they get upset, they're going to take to the streets. We have watched what's going on in Ecuador. We have seen this in London and different places around the world, major cities that have simply erupted into chaos. Could be different reasons. There could be an unlimited number of reasons why this would occur, but you're seeing it time time and time again. And with the currency depreciation ongoing, it's only gonna get worse. Because if people are affluent, if people are able to benefit from what's happening in the world, generally they are more pleasant, they are dealing with issues on a different level, okay? But when people are in a state of poverty or they are pushed to the edge, they are going to rebel. So this is something that I want to make very, very clear. Let's get into it deeper. Hong Kong is on the verge of its first recession since the financial crisis. This chart just shows you that we haven't seen these levels for a very long time. This article here is just basically trying to highlight what's happening in the auto industry. We have seen some serious, very serious problems right now. And although it is one industry, it's a very unusual situation because we're seeing the prices of these vehicles increase. We have watched as people take longer and longer and longer to pay off their vehicles. And of course, we have seen the delinquencies rise. Rising old used car prices help push the poor Americans over the edge. For America's working poor, an often essential ingredient for getting and keeping a job, having a car has rarely been more costly, and millions of people are finding it impossible to keep up with payments despite prolonged economic growth and low unemployment. Well, of course, if they were looking at the real data, they'd be able to tell what's actually going on. But anyway, this just shows you that there are a whole bunch of people that are being affected by something so simple as car affordability. Now, I know there's going to be a whole bunch of people that are buying a car they can't afford in the first place. The payments are huge. They want to get the luxury vehicle instead of getting something used that is sufficient for their needs. I understand that, but it just shows you that something is definitely going on right now, and it's coming from all different angles. I've highlighted this on many occasions, but there are 7 million people in the United States that are 90 plus days delinquent on their payments. Auto loans, which is the green line here, you can see that this has increased quite significantly over the past couple years, and that's not a good sign, of course. This is all interconnected to what we are seeing with the derivatives on these auto loans, and that could definitely spiral out of control. And you would look at the percentage and say to yourself, by the way, this line here is 5%, you might say, well, that's a very small percentage. So 5% I'm not worried about. But look at the percentage of subprime loans back in 2007, and you will find that in general, it's still significantly lower than the prime loans. It has nothing to do with what's going on in that market in terms of the size of the entire market. It's the fact that derivatives interconnect all of this together. It's a big issue, and the average person simply doesn't want to know about it. This information is out there if they would spend a few minutes to learn it, but of course they won't. So this just shows you a chart comparing the student loans and the credit cards and all of this business. But I simply wanted to highlight the auto loans because this is something that really isn't talked about enough in the media. What we get here on this channel in the comment section, I've seen it multiple times before, where they will take the 7 million, okay? 7 million people, 90 plus days delinquent. Some people are looking at that and saying, oh my goodness, 7 million people are not able to pay their vehicles? That's very serious. And then we have another group of people who are probably owners, 7 share of Amazon type owners. And then we have another group of people who probably own 7 shares of Amazon, who will divide 300 million by 7 million and tell me that nothing is wrong. Well, first of all, why are you dividing the 300 million by the 7 million? It doesn't make any sense at all. This is the senselessness that we see on a daily basis, and it's just complete ignorance to do something like that. The trade issues between the US and China weigh heavily on air cargo. So as I said, it's not just one industry, it's not just one sector, but we are seeing this all over the place. Whether it's air, sea, or land, we are seeing this affecting all different sectors, all different markets, all different industries, and that of course takes a toll and the ripple effect. If people are having problems in one sector, it's going to spill over into the next. I hear it all the time. Where I live, everything is fantastic. What the hell are you talking about? Look, I don't know where you live. I can't tell you about where you're coming from, but I look at data. I look at information, and I pull this from all over the place, all around the world, all different sources. If there is something that you disagree with, contact these companies and file a complaint with them. Tell them that they're not telling the truth. I'm just trying to bring you information that is generally not available to the public. If there's an issue, you got to take it up with them. I am simply the messenger. That's all for this video. If you found it informative, hit the like button. If you click one button on your way out, you are supporting this channel. That apparently is very difficult to do for a lot of people. If you want to make money, if you want passive income, I created the Amazon GPS. Now, this course here is fantastic for people who know nothing about passive income or business or online investing. We have to start looking at this as a business, okay? Because you put a certain amount of money in and you expect a certain return. Don't look at it on the surface level as you've seen online. People are going to sway you in one direction or another, all this clickbait garbage. I simply give you what you need to know. And by the way, that I mentioned it's free, 100% free. It's at the AmazonGPS.com. If you want the financial education, if you want to learn about the history, the foundation, the asset classes, making money, all the steps you need are in these two books. Check them out at the link in the description if you want the audiobook. That's available at themoneygps.com. Wait a second, hold on. Have you seen this video yet? It is incredibly packed with information that I believe you'd be interested in, so click on it and I will see you there.